Welcome back. Thank you so much for staying with us. Right about now, it's Biashara Tuesday, and this morning we want to take a look at our lending habits in the first half of 2025. Of course, that is marked by a period between January 1st to June 30, and as we all know, it has been a turbulent few quarters for borrowers and, of course, lenders alike. Interest rates have remained high, and access to affordable credit is, still out of reach for many Kenyans and lots of businesses in the country. So to help me with this conversation, just to, to talk about who is getting these loans, how are they getting these loans, how is our lending habit, and what can we do maybe to improve, or can we really maintain this habit in the coming half, that is the second half after starting July next month. To help with this conversation is George Munga, a finance and accounts insurance analyst. Karibu sana to Morning Cafe.
Thank you.
Yes. So I want us to start off from, a global perspective, just before we set the stage for how you're doing in the country. Could you provide an overview of the global landscape in regards to lending habits in the first half of 2025?
Lending habits, especially for our local economy, is dependent on the geo money market, and it's also tied to the geopolitics. If you look at the the federal market in the US, the lending has been high, though it has stabilized over the last 2 quarters. Mainly because you realize the U.S. government had a bit of deficit for the first few years. For the last 2 years, it had a bit of budget deficit that the current administration is struggling with, and that has impacted heavily on the interest rates that are charged on the public debt that is in the U.S. And if that happens, then it boils down to now markets like us that now look at those bigger markets to guide our monetary policy. You look at the China market, also has struggled a bit over the last 2 years. Remember when they had the real estate bubble of I think that was in 2022, 2023, and that really affected the money markets in China. Those are big economies, so those shocks might not affect them so much. But you realize that if there are those shocks, then now the lending that comes now to the emerging markets like ours now goes down. And if that happens, they realize our interest rates go up. So that is why you realize in Kenya, I think in 2022, 2023, our rates were quite steep. But because those markets are stabilizing, our interest rates are going down, though not so fast, but they're going down. Remember, we had our interests had capped around 24%. That was in 2022, 2023. Currently, we are doing 16, 17%, which is relatively not so bad, but not as good as we want it to be. So that's the background of the high interest rates that we've had in our economy over the last 2 or 3 years.
But how has this shift impacted borrowers' behaviors and access to credit in general?
It has, because as I was telling you, if the foreign markets cannot lend to our local economy, that is the Kenyan economy, the government now goes back to the local money market to borrow. That is why you realize over the last 2 years, the government has really absorbed a lot of money from the local market. When government does that, then it now does what we call crowding out the private sector, or it is competing the private sector for the little capital that we have in the local economy. So if that happens, then most commercial banks or most pension funds would want now to lend to the government because they are more secure. And of course, the risk of them losing that the money is very little. So they'll pump most of their money to the public debt as opposed to the private sector. So when that happens, then the way they do that is to raise interest so that it becomes less attractive to the private sector to borrow from them as they pump more money to the public sector. When public sector debt demand goes down, they realize that they now want to channel more money to the private sector, and therefore their rates must come down. If you remember in 2003, 2004, our rates were quite low. And remember, commercial banks were literally hawking loans to private individuals, private households. What had happened at that time is that government appetite for debt was so low. So commercial banks had to look for avenues to dispose of their capital. Remember, commercial banks have a lot of liquidity, and when they keep that liquidity, it is a cost to them. So they always want to dispose of that liquidity to earn interest on that money. So when government is not borrowing, they look for avenues to dispose of that money now to the private households, to the private companies, and that is why interest rates at that time were quite low, and private sector lending was quite high.
Yeah. So in comparison to second half of 2024 and now the first half of 2025, how would you say we are doing? Because of course we cannot compare this first half with 2024's first half. Correct. So how would you say we are doing? Are we doing badly, or would you say that things that we need to do to just try and improve, or things that you saw that were good for last year that you would say that we need to maintain?
There are indicators to the money market or to the lending rates in the market. And one of the most critical indicators is what we call a CBR rate. CBR rate is the minimum rate that the central bank lends now to the commercial banks in the market. I realized over the last 1 year, that's the better part of 2024, the CBR rate was going at 12 to 13%. By February this year, it had come down to 10.75%. The latest Monetary Policy Committee announcements, they brought it 10%. What that portends is central bank is trying to tell commercial banks to push down their lending rates. And if you look at the lending rates, it has taken that trajectory. Last year, commercial banks were lending at 19-20%. Early this year, we were doing 17.95%. Currently, most commercial banks, the average lending rate is at around 16.8%. So that is a good trajectory that commercial banks are taking. And if the CBR rate was to go much lower, say to 8 or 9%, then you realize that the interest rate will go to maybe 15 or 14%. So in as much as things are not where we want them to be, but again, the improvements or the trajectory that we are getting from the market is that the rates are going down. Number two factor that most commercial banks look at, or that central bank looks at when they're looking at their interest rates, is the inflation rate levels. Remember, our inflation rates over the last 1 year has been quite stable at around 3 to 4%, which is the lowest that we've had. I think we had very high inflation rates in 2022 and 2023, but 2024 coming 2025, the inflation rates have stabilized. When inflation rates stabilizes, then you realize that interest rates tend to come down, because now the rate of the depreciation of the currency is not as high as it used to be. So that is the other factor that has necessitated interest rates to come down. The third most important factor is the exchange rates. Remember, early last year, or late 2023, early 2024, our exchange rate went as high as 160 to the dollar, if you can remember. They came down to 140, and currently the average exchange rate is at 128 to the dollar, and has stayed there for quite some time. Because of that stability, also interest rates in the market are quite stabilized and are going down. I expect that maybe by the end of the year, our rate should stabilize between 15 to 16%, which is a good rate for our economy.
So if you're looking at the interest rate being capped to just staying stable at 16%, as you say it. So for the benefit of our viewer, what does it mean for Kenyans? Is this something that they should be joyful about, or, sit down and be sad about it?
No, that's a good thing. Remember, when interest rates are low, or when interest rates are stable, remember from your economics class, the most important factors of production is a land of cost and capital. And capital is money, and that's what you're talking about. If you can get capital at a rate that is cheap, or that's affordable to you, then you can go and invest and get some return. Then again, apart from interest rates being low or being stable, being at a certain level, there's what we call stability. If rates are stable, then you can budget with it. But if today the rate is at 16, tomorrow it's at 20, the next day it's at 30, then you cannot be able to budget easily for your business. But when they're stable, then you can budget for the next 1, 2, or even 3 years. So you can say that my cost of capital for the next 1 or 2 years is going to be XYZ amount, because I can project the interest rate. So if you have interest rates at 15 or 16%, then you'll have more private sector companies going to commercial banks to borrow to be able to invest in the economy. When rates are high, then you'll realize that most commercial enterprises will not be attracted to go and borrow from commercial banks to invest. And at that particular time, you realize that most investors now start going down. Or those who take money to invest, they cannot be able to recoup that money and pay back the interest. And that is where now the loan defaults come in. And that's an effect not only on the commercial enterprise that borrowed, but also the commercial bank that lent this money.
Now that you've mentioned the NPL, non-performing loans, of course this could lead to tighter credit and, also be on the bad side for everyone who wants to lend. So really, how are lenders trying to mitigate such risks when NPLs are now something to be talked about?
Most commercial banks last year struggled with NPLs, and if you followed most of their quarter one announcements closely, you realize that most commercial banks, their quarter one profits either plateaued or dipped. A good example is Equity Bank, their Kenyan operations, their profits for quarter one dipped. The biggest contributor to that dip was the NPLs. Most clients who borrowed over the last 1 year were not able to keep up with their installments as it's required. And if that happens, then there's a requirement of what we call IFRS 9, that is the provision. You must make provision for anybody who is not able to keep up with these payments over a 3-month period. If I get a loan today and I cannot make payments, my installments for the next 3 months, then central bank requires that the bank must provide for that loan at a certain percentage, and that provision must go into your PN, profit and loss, and that explains why most commercial banks reported decline in their interests or decline in their in their profits. Now, how do commercial banks deal with NPLs? One is by tightening the screening procedure when they're lending to private enterprises, to households. That is number one. That is why you realize that for some time now, lending to private households has been quite slow, if you realize. So that is to manage that, to mitigate that risk. The other bit is that if that risk is elevated, then you realize that commercial banks will do what we call risk-adjusted pricing, meaning they look at Anne and look at George and they charge me a different interest rate, as opposed to Anne if they look at think I am more risky than, and that is why you'll go into bank. Somebody will be charged 24%, another person will be charged 12%. That is the risk pricing that banks considers when it's lending to you. The other thing that they do is, of course,
what are they looking at exactly? When they want to now give you 24% and give me 27%, how are they evaluating that I really deserve and I qualify for this 24% and you qualify for 27%?
There's a tool that they nowadays, of course, use that I know you know. That is the CRB rating. CRB will look at your borrowing history over the last from the first time you borrowed and look at how you've been paying your loans, and they'll give you a grade. So that's the grade that they use. But now, more specifically or more critically, a bank will look at if you've had a good borrowing history, you've borrowed a loan A, you've paid successfully, loan B, you've paid successfully, loan C, then they consider a low risk borrower. Therefore, your rates will come down. But if you borrowed the other loan and you struggled paying, maybe you skipped installments, then you become a high risk client. Then your interest rate goes up. The other thing they look at the industry that you're going to put this money. If, for example, you're picking money to go and invest in, say, a betting company, then your risk profile is quite high. I'm just giving a hypothetical example. Yes. But if you're borrowing this money to, say, go and invest in T-bills, then they consider that investment to be risk-free, and therefore your rates will be quite low.
All right.
That's how they look at it.
So of course you're telling me how banks are just trying to mitigate this risk of dealing with NPLs. Correct. And of course you were talking about how now they're trying to just stabilize or not give same interest rates. Correct. So that is one. What are others that exist?
Apart from those, of course, banks grade they have a grading for all their clients. Whenever you go open your account, the bank will require you to fill this form that you fill. That's quite a number of details. Those details, most banks currently, especially the big banks, they have algorithms that will just grade you and see this is the risk grade that you that you have. So even for a first time borrower, they know how to grade you or how to charge you if they were to lend to you. But the other thing that banks look at, of course, I talked about the industry, and they have graded all the industries. They know industry A, this is the risk profile. Industry B, this is the risk profile. So whatever industry that you are borrowing to go and invest in, they know the risk profile that they are picking, and therefore the rate that they'll apply.
Yes. And that also brings me to the question of syndicated lending. What notable trends have you noticed in the first half of 2025?
Syndicated loans are now coming if a client is too big, or the loan portfolio that a client needs is too big for a single commercial banks to absorb. There's something that commercial banks call a single obligor limit, meaning the amount of money that they can borrow to a single borrower. And that is tied now to their capital. Most commercial banks have various amounts of single obligor limits depending on their capital levels. But again, there is a central bank requirement or central bank regulation when it comes to single obligor limit. What it says is that you cannot lend to one individual client more than 10% of your core capital. Meaning if your capital is $1 million, then you cannot lend to one individual client more than 100,000. That's what we call the single obligor limit. If, for example, a client of yours, say a client of XYZ bank, wanted to now borrow, say, 3 billion, and this bank cannot absorb that entire 3 billion. But since it is the anchor bank, they will go into what we call a syndicated arrangement, where they will be the anchor bank, but they will invite other banks to come and subscribe to this loan portfolio. So then they'll say, as you're going to lend, say, 100 million, Bank B will lend, say, 500 million. Bank C will lend, say, 1 billion to bring it to the total of maybe the 3 billion. And then now, when they're taking the security, now the first charge goes to Bank A, and then Bank C now gives a second charge to Bank B and Bank C, so that all of them are secured. But Bank A, the regional bank, is the principal lender. So if this customer was to default in this loan, then Bank A is responsible for ensuring that these other lenders are secured. Yes.
So what industries have you noticed leading in the syndicated loan uptake?
Most industries that lead the syndicated loan uptake is manufacturing. Remember, manufacturing requires a lot of very huge initial investment. I'll give you an example. I'll not give you names, but I'll give you an example of a milling company that is in Kirinyaga, if I'm not wrong, that required a facility of, I think, around 800 million. Because of single obligor limit, their principal banker couldn't lend to them that entire amount. So they invited 2 other banks to subscribe to this facility. What they were doing is they were bringing in a plant from China to be able to build up their capacity in milling. So as I was saying, manufacturing are the biggest because of the initial investment required in their operations. Of course, the other industry that normally requires syndication is service. I'll give you also an example of a new university that just came in recently, not so long ago. I'll not mention names because of course confidentiality, but because of the level of facilities that they require, the amount that they required to put up whatever they wanted to do was more than 3 billion, and therefore they had to do syndication from the principal banker to be able to raise that amount of money. So these are the examples that I can
think of.
Yes.
But is it really a better option when we think about these services and industries and companies trying to get these syndicated loans? What happens now when they cannot come up with a particular paying plan for these loans that they were taken? Then what happens, and what are the risk factors associated with a service or a company just, taking up a syndicate loan?
Syndicated loans work both for the borrower and the lender. Let me start with the lender. It works for the lender because now you spread the risk. If I'm a lender, and I'm lending, say, to a borrower borrowing, say, 5 billion, and as myself as the first lender, I'm lending, say, 1 billion. The second is lending another billion. The third is another billion. So you find out that our risks my risk is spread over these three. So in case this this borrower was to default, then my only cost or my own loss is 1 billion, as opposed to losing the entire 3 billion. Number two, there's the capital investment. Remember, most of these banks have different liquidity levels. Bank A might have a liquidity level of say 1 billion shillings. Bank B maybe 5 billion. Bank C maybe 10 billion. So if I was to pick my entire billion and invest and give this single borrower, then I don't have liquidity to service my other client. So I would give a smaller portion of my liquidity to this individual client and still leave me leverage to borrow. To lend to the other client. So you give me leverage to still service my client, yes, but still has money to lend to the other guys. The advantage to the borrower is this. The borrower doesn't have the headache of going to all these banks at the same time, because every bank has their requirements. Me, I'll approach my principal banker, and my principal banker will now make this the entire arrangement. So me, I'll be dealing with my banker. In my mind, as the borrower, I know I'm dealing with my principal banker. Whatever they do now will just be documentation. So when I'm arranging my repayment, then I know I'm servicing a loan of 3 billion, and this is my monthly repayment. I don't have to worry about the amount of repayment that I have to give to Bank B, the amount of repayment I have to give to Bank C. In case of a run on the bank, it has happened in this country, so I'm not shy from mentioning it. Yeah. My risk as a borrower is still down, because I don't have to worry about Bank C going down, because I know Bank B and Bank A are still up. Those are the advantages. And then the last and most important advantage is that in most of these syndicated loans, the rates are quite low. They're not as high as if I'm borrowing from an individual bank, because you realize that all these three or four banks will have to agree on a particular rate that they're going to give. I realize most of the rates that are given for these loans are quite manageable. So
the benefits that the lender has outweighs the benefits that a borrower has.
Both of them benefit. Both of them benefit. Almost equally.
Almost equally.
Yes.
But have we also witnessed NPLs in syndicated loans?
Yes, there are. I'll give you an example. This is a public quoted company, so I'll not shy away from mentioning it. A river mining company. I think that was in 2005 to 2006. That was not able to finance their facility, and I think they struggled very heavily with their repayment. And that loan has been circulated between quite a number of commercial banks around, and that affected heavily the liquidities of those commercial banks. So it has happened, and it can happen. Just like any other borrower, this syndicated loan can also go bad if the business environment is not good.
Well, that is quite an interesting topic if you're talking about having NPLs, in a syndicated loan. Now that a lot of lending companies are involved, then how does he or she pay if collateral is involved in this case? Or is it collateral involved when we're talking about syndicated loans? How does the borrower now get to offset this loan? Because at the end of the day, it has to be paid, right?
Yes. In most cases, you find that these loans are collateralized, meaning they're secured. And the banks are secured what we call pari passu, meaning if I've charged this property for say 1 billion shillings, and Bank A has lent me 100 million. So Bank A, so to speak, owns 100 million of this building. Bank B, who has lent me 200 million, owns. So in case of I'm not able to pay, and the banks were to liquidate the security, then they liquidate the security and pay all these commercial banks pro rata. Meaning, if the amount they have realized from this security is not enough to cover the entire loan, then each and every lender will get a portion of what they had lent.
Interesting. Now, there's private credits as well, of course, which reports show substantial growth in this sector. And, you know, private credit markets has expanded approximately over $2 trillion globally. Could you elaborate what is, you know, the factors that are contributing to this trend, the private credits?
More specifically to Kenya, the private sector lending has grown, not at the rate that we'd want it to be, but it has grown at around 5% over, that is year on year. Currently, the private sector credit stands at 4.8 trillion, that is in Kenya, as opposed to 6.5 trillion to the public sector. And the growth has been driven majorly to the service sector, majorly to the manufacturing sector, and then to fintechs, and of course agricultural. Those are our major economic drivers currently. Our private sector growth, or private sector credit growth in 2023 was not very good. 2024 it started picking up, and currently it is picking up quite well, of course, because of the outward look on our economy. We expect manufacturing to pick up this year, and the service sector. Remember, Kenya is driven majorly by service and manufacturing and agriculture. Of course, fintechs are coming in very strongly. So we expect private sector growth to go to as high as 5 trillion, maybe by the end of this year or early next year. And that means for the market is, number one, that there'll be increase in employment, of course, because as private sector companies grow, they would want to absorb more manpower, and if there is more credit in that sector, then they'll have to employ more individuals to be able to run their enterprises. And number two, there'll be increased production and therefore GDP. And if you looked at the IMF and the World Bank projections for this year, they're projecting our growth to be between 4.8 to 5% over the next 1 year, and that is largely from private sector growth. Number three, when the private sector grows, then you realize that even the commercial banks themselves now grow, because if there's increased lending to the private sector, then the loan portfolios of the major commercial banks will definitely have to grow, and you'll see them reporting very healthy profits at the end of the year.
So you're saying we're not doing well as we should. So what are the gaps exactly that, you know, we should be looking into and just trying to fill and ensure that we get to where we need to get in terms of private borrowing?
If you are looking at the flip, I mean, this was flipped, so that the private sector credit would be 6 trillion and public sector would be 4 trillion, then that would be a very good position we are in. The reason is public sector in most cases is very inefficient, and therefore monies that go into public sector in most cases, especially in our setup in Kenya, mostly end up being misappropriated. Let me put it that way, because we have those Auditor General's report. But private sector, when money is pumped there, then it goes directly into production, because a private sector individual knows that this facility has to be repaid, and there is a cost implication to it. So, as an economist or as a finance person, I would love to see that flipped, so that a bigger percentage of our credit goes to private sector, and a smaller percentage goes to the public sector. That will, one, bring interests down, because if there's a lot of liquidity that is going toward the private sector, then commercial banks will be forced to bring their rates down to attract more private sector borrowers into their books. And if the rates are down, then the cost of doing business comes down, and therefore there's more production in the market. So from where I sit, I would want to see private sector growth outpace public sector debt growth.
But what are the risk factors that maybe would be associated, if any, with a rapid growth of, private credit, if any?
The only risk that is associated with private sector credit growth is inflation. That's the only risk that we normally associate with private sector credit growth, because when there's a lot of money, there's a lot of liquidity in the economy, then of course inflation is a factor that you must consider. But I think over the last 1 year, the central bank and the extension treasury has really managed our inflation rates. If our inflation is below 5%, we normally don't worry. But the moment it goes past 5%, then we have a cause to worry. So that is normally the only risk factor that we have when private sector private credit growth goes up. Yes.
Something that I know maybe our viewers would love is, when you're talking about mortgage lending for the first half, that is 1st June to 30th June 2025, what developments have you seen in this sector for this first half?
Our real estate sector slowed down, Anne, if you looked at it. I think we had our real estate sector peaked around 2010, 2011, 2012, but it has slowed down quite extensively. And most companies that were in that space, remember, have struggled. Remember, if you can remember Suraya, remember Saito, they have struggled quite a bit. I think because of the market shocks that were in that market. The reason is that there was a mismatch between the liquidity that was in the market and the timing for the liquidity that's in the market and the timing for the liquidity required for the mortgage finance. Remember, for most mortgage borrowers, they would want financing for between 10, 15, 20 years, meaning they need long-term financing to be able to pay off their mortgages. Yet what we have in the market, in most cases, are short-term facilities or short-term liquidity. Remember, most banks, the major source of liquidity is customer deposits. And most customers, either they have what we call current account deposits or deposits on demand, meaning if I put my 100,000 today in bank A, I would want, if I go there tomorrow, I can withdraw it, or what we call time deposit. And most time deposits, maximum is 1 year, meaning a customer can put in a time deposit today, but after 1 year, they want that money back. So in most cases, the liquidity that's in the market is more shorter term, and the liquidity that's required for mortgages are more longer term. That has been the mismatch that we have in the market, that if we can bridge, then we can be able to finance more mortgages. Pension funds are able to do that because pension funds are more longer term. Because if I enter into employment today, I start saving for my pension immediately, and maybe I'll withdraw it after maybe 20, 30 years. But remember, in Kenya, our pension laws or our pension regulation is such that a very small percentage of our income goes into pension, and the amount that goes, the one that goes to government is normally not you cannot budget with it, because the one that goes to NSSF. But now the ones that goes to more structured pension funds are not quite heavy. But it's assisted the market to navigate that space. Remember, most pension funds are the ones who invest in the much longer term projects. And I like what government was proposing. I think over the last quarter, of the last 3 quarters, that they would want to invite the pension funds to participate in PPPs, the public-private sector partnerships. These are good because these are long-term projects, and we would invite our pension practitioners to invest in such long-term projects.
So what you're trying to say is, as at now, the pension funds that go to the pension cannot really offset these mortgage loans that exist for people who take up mortgage.
Yes, their capacity is not that huge. If you look at our pension fund space, there are not very many players in that space. You can mention maybe not more than 10, and the amount of liquidity that they have is not that strong. If you look at our money market, most of the liquidity, a big percentage of the liquidity, over I think almost 60% of the liquidity, are held by commercial banks, and then the rest is now shared between SACCOs, microfinance institutions, of course the pension funds. So a bigger percentage of our liquidity is short-term because most commercial banks hold more short-term liquidity, and then now the pension funds hold the longer-term liquidity. So that is the mismatch in the market. So our money market is such that we can only be able to do shorter-term projects or shorter-term lending as opposed to the longer-term lending. What has happened in more developed economies, Anne? Let me give you an example of China. Is that they have more long-term funds as opposed to the short-term funds. The reason is, I think, they have the advantage of population. Remember, China's population is almost 1.3 billion, and their pension laws requires that immediately you start working, you must save with the pension, and therefore they have that pool of long-term finance that then can now invest in more longer-term projects. That is why you can see China investing in very heavy long-term projects, even in our country, because of those kinds of funds. If our laws would allow us to do that, then you'll find it easier for commercial banks or for pension funds now to participate in the mortgage companies or in the longer term projects.
So what other payment options exist, for Kenyans taking up these mortgage loans if pension finance is not an option for them?
Of course, the only option currently we have for mortgages are commercial banks, unfortunately, because again, pension funds don't invest directly.
But does everyone
They don't
qualify
invest directly
for
in the
commercial
mortgage, so they'll still come back to the commercial banks. The way they do it, a commercial bank would issue like a note, a credit note to maybe a pension fund. Then the pension fund now invest in them, and then they now give you the money as a mortgage. But if pension funds were allowed to invest in mortgages directly, then I think it would make our work easier. So that goes back to legislation to allow them to invest in mortgages directly. Maybe that's something that you can propose to Parliament.
Now that you sit at a very possible space, to suggest such issues, but now that means that not many Kenyans can now get access to mortgage loans. Just live in a house where they prefer, because payment could possibly be a challenge, right?
Definitely. If you look at the percentage of mortgages in Kenya, I think it's less than 10%. That tells you that most individuals or most households are not able to access mortgages. So it is something that the countries developing. I know even at our 10%, and we are still better than most African countries. I can tell you that. Yes. So we're not a very good space, but where we are, we can build from it.
We are not doing badly.
Yes, we are not doing very.
Okay.
We are not doing very badly, but we can build from it. I think from where I see what the gap is in the legislation, because you find the holders of these longer term pensions are not they're not able to invest directly in mortgages. So if the legislation could be changed such a way they can invest in mortgages, then it will flip over very easily.
So how has these changes affected housing affordability and of course market dynamics as well?
Housing in Kenya, most governments have struggled with housing in Kenya. Remember, the NAC government had the same agenda. They struggled with it. They didn't quite hack it very well, though they tried. Of course, the Jubilee government tried to do something in that space, and of course, the Kenya Kwanza government has also tried to do something in that space. I think what has the challenge has been the structure of that space. How do we finance housing in Kenya? I know it was the current administration tried to do what they have done. It was not very popular, but it was a step towards maybe what government should be thinking along. I think, in my opinion, this should have been more voluntary, so that I'm investing part of my income in a fund that I know after a given period of time, I'm able to get a property or get an asset that is equivalent to what I've saved, or then I can top up, or the government can top for me up, and then I get a house. At the current structure, the problem I have is as a taxpayer for the affordable housing, I'm not guaranteed that I'll get that particular house.
Yes.
So it becomes a cost to me and not a saving. Initially, the proposal was it was to be a saving from the individual taxpayer, so that as I contribute, then I'm contributing to a fund that will enable me get a property at the end of a period of time. Then that would have made a lot of sense to most individuals or to most households. But it was flipped over so that it became more of a tax on the individual taxpayer as opposed to being a commercial saving on the individual taxpayer. But maybe it is a step in one step in the right direction. You never know, because at least we've seen properties coming.
We're just starting.
What we don't know is how will they be allocated. That's what we don't.
Yes. And when you talk about top up, maybe the government can now top up for you on whatever you contributed. Do you see it possible maybe for somebody who gets a unit, say a bid seater at the moment, do you see it possible for them to get a top up of maybe a 1-bedroom, a 2-bedroom, a 3-bedroom, of course, as their family expands? Is that something that is possible with this framework, if it's something to look at?
It is possible. It is possible. And by the way, to give credit where it is due, those houses are fairly priced, so to speak. What I don't know is the criteria of allocation. I've not tried myself, so I'm not believe the government so much on that. But I believe there's a process of register, and then you are screened, and then you're seen if you're eligible for that particular property. What I know the gap that is there is how do you get finance? Because currently, if the property is priced at say 3 million, then you must put the 3 million. You get a facility to be able to put up the 3 million for that particular property. In my view, and what I would have loved to see is that if I've been taxed for the last 2 years, then that goes into a deposit for that particular property, so that I just look for a top-up for the difference, and I own the property. And the government makes it possible for me to be able to get that difference. The government had proposed something. I think that was 2012 around the mortgage refinance company, where people would go and get mortgage. Maybe. Government it still exists. Yes, it still exists. But I don't know if it's very active. I don't know if it's still doing the job it's supposed to do. The government would have pumped in money that has collected from the affordable housing levy into that fund, so that when I go there as an individual who has been paying this tax, then I can easily get that money at very reasonable interest rates, say 8 or 9%, and go and buy that property. It will be more palatable to more households, and more households will be drawn towards that.
Absolutely, it will help with, of course, mortgage lending as well. But, from a finance and risk analysis perspective, if you're looking at the current credit climate in the country, what does that tell us about, the financial health of Kenyans and, of course, our Kenyan households and businesses as well?
There's something that commercial banks will not shout out about, but there's something called business failures in the market that has been quite rampant over the last 2 years. Most businesses have collapsed, and so to speak. Let me be candid with you, because I can in that space. And therefore, if that is the case, then you'll find most commercial banks slowing down in their lending, because if I lend to company A and it goes down, then it goes down with that money. The effect is, remember, banks don't lend their money. Banks really don't have money to lend. They'll pick money from Anne to lend to George, and then pick money from other banks to lend to. So when a particular borrower goes down, then it goes down with the borrower's money. If that was to happen over, say, for 20% of their clients, then they can't be run on a commercial banks, and we've seen that in our country. So what banks do is that if that happens, then they really slow down lending to private enterprises. And when they slow down lending, then you'll see the economic growth is not as fast as it's supposed to be. So private sector credit has slowed down last. It is picking up now, because I think businesses are starting to come up again and start to have some trade, but not as fast as it used to be. But we are looking at maybe end of this year, if things were to pick up, then you'll see more private sector credit going up, maybe in 2025 and 2026.
So are we seeing more borrowing to survive rather than to expand? And how sustainable is this trend?
Most enterprises apparently are borrowing to pay salaries, borrowing for their day-to-day operation.
Borrowing to pay salaries?
Yes. Borrowing to pay salaries. And that's not sustainable, because if I borrow this month and I pay my salaries, next month I go and borrow and pay my salary. If I do that for, say, 3, 4, 5 months, then it has eaten into my capital as a business. And that is why at the end of, after a given period of time, you find this business going down. But even when it comes to households, most households currently are borrowing for their day-to-day survival.
Yeah.
To pay school fees, just even to put food on the table. I mean, households are borrowing for that. That is how serious things are in the economy. And if that happens, then we are more of borrowing for consumption as opposed to borrowing for development. And that is why you see sometimes you say there's no money in there, because there's no development projects coming into the market, and therefore that affects even the liquidity in the market.
So how is this reflected in the LPS? I know we've talked about how these lenders can now mitigate this risk, but are they really prepared for potential defaults in this line when we're talking about people are borrowing just to survive?
When you borrow for consumption, Anne, what it means is that you don't have a repayment cushion in the future, because that money you borrowed today and you've consumed it. How are you going to pay that loan for the tenure of that loan? Or if a company was to borrow for salaries, remember salaries are recurrent, meaning if I pay salaries this month, June I have to pay salaries, July I have to pay salaries. So if I borrowed this month to pay salaries, meaning if any liquidity that I get now in the month of June or July, I must first of all repay that loan so that I can maybe borrow again. So if you borrow for consumption, there is no repayment cushion. So I have to get somewhere to be able to pay that loan. Or on the worst case scenario, then I'll default in that loan. That is why for clients or for borrowers that normally borrow for consumption, their risk of non-performance are very high. Why? Because that money was not invested to be able to repay itself. The best facility is a facility that is self-liquidating, meaning I borrow a facility today, I go and invest it somewhere, and from where I invest it, I can get liquidity to be able to repay this facility. That's the best facility. But a facility that I borrow today, and I don't invest or I consume, and then I have to look for money to pay, I'll struggle with that. I'll struggle with that payment.
So in short, that only, takes us into more debt, as Kenyans and people who keep on borrowing. But there's also been a lot of noise around digital lending. It's fast. Usually it has no collateral with it, but it also seeks to fill a gap that these traditional banks haven't always been able to fill. But do you see the gap closing?
Most digital lenders apparently are lending for consumption. That I can tell you, and that is why they have become very popular with Kenya. Remember, Kenyans have struggled a bit over the last, I think, 2 or 3 years, and people are living hand to mouth, so to speak. So if I cannot be able to get what I'm going to put on the table today, then I'm forced to borrow, and it will be easier for me if I can get that facility very easily. But now on the flip side, and the challenge with these lending apps is that the interest rates are very, very high. Remember, they charge as high as, I think, 60% per annum, meaning 5% per month. Those are very high interest rates. So at the end of the day, you are losing instead of gaining. So if I borrowed 10,000, then I think you pay 13,000 or even 14 or 15,000 for that kind of facility. So at the end of the day, you are draining. It's draining money from you as opposed to putting in money into your pocket. The other thing is, this is not money that you can borrow to be able to put into a business, because most businesses in the country would pay you a return of maybe 20 or 30%. If you're borrowing for a business that is going to pay you 20% or 30%, and you're paying interest of 60%, then the net you are losing. That's why at the end of the day, you'll find if you borrow this money to be able to, put in a business, that business will struggle, and that loan is likely to become non-performing.
And you also mentioned something about most Kenyans are borrowing to pay They borrow, they borrow, they pay, they borrow, they pay.
It is a cycle. It's a cycle. So I borrow here to repay this, and I borrow here to repay this, and that's why the top up phenomenon comes in. So we always want to top up so that I get something small, but the big percentage of the facility goes towards the repayment of the previous loan. Yeah,
you said digital lenders often, they borrow for consumption, but I've seen a couple of digital lending apps that give clients even up to 200,000 Kenyan shillings. But 200,000 Kenyan shillings is not small money. That is something that a bank can give you and fail to give you. But would you say that we are seeing a trend where banks are losing out to digital lenders?
I think they complement, and if you are to ask me,
they do.
There is the risk element that banks will not be able to take. The reason why I say they complement one another is this. Is remember, banks are regulated. And therefore, there's an interest rate that they cannot charge. Remember, a bank cannot charge you today. A bank cannot charge you interest of more than 25%. Otherwise, central bank will be on their case. But if a bank was to do that kind of lending that the mobile app lenders are doing, then they'll be required to pay. To charge 60%. Why do these mobile lenders charge those high interest rates? Because they charge so that if Anne defaults, then George pays. Then the interest rate that I pay is able to cover Anne. That's the logic behind their high interest rate. So that if out of a pool of 10, if 3 defaults, the interest rate that the other 7 pays or the other pay is able to cover this other. So even if we lose this other 2 or 3, then we are still covered. But commercial banks are regulated, and therefore they cannot charge those astronomical interest rates. That is why I say they complement, because these are now people are covering that gap that the commercial bank cannot be able to cover.
And I'm looking at it from the angle of no collateral available for digital lending, which of course a lot of Kenyans love.
Correct.
And if you're looking at it, banks, would want you to give your car, they would want you to give your house. But for digital lending, do you see it as something that is sustainable, something that will be here even in the long term, if you're looking at it just as a lending habit for Kenyans?
It is our equivalent of credit cards in the US. Remember, the US also struggled with credit cards quite heavily because the US credit cards are the easiest source of borrowed funds in the US. In our case, I think the mobile lenders cover that space. I can tell you for sure that they're here to stay, and they're here for the longer term.
Yeah.
One is because of our consumption habits. I think there's an economist who said that we are a consumption company, and let us face the truth. So if you're a consumption economy, then we must be able to finance that consumption. And what is the best way to finance the consumption than from a company that can be able to give you money for consumption without a lot of detail around it? And that is where the mobile lenders come in. So they're here to stay.
They're not going anywhere.
Correct.
So of course, as we wind up, George, we are halfway through to 2025, of course. What would you advise we do as a country, or should be done, to improve, our lending environment, just to ensure that we are doing well in regards to lending, borrowing? Of course, we are getting into the second half next month. So what should we do better, and what do you see that we've not actually done best in this first half that we should not carry on to the second half?
I think there are 2 or 3 things that we need to do, and most of them are from, of course, the government side. As an individual, there's very little you can do to change the dynamics in the lending, in the money market, or in the lending space. Number one, our CBR rate is carrying at 10%. Therefore, the average commercial lending rates in the market is around 16.5%. If our CBR rate was to come to, say, 8%, then our interest rates will go to between 14 and 15%, which is a very fair rate in the market. Why am I saying it's very fair rate? Remember, I told you that most businesses in Kenya earn between 20 to 30% return. Net return at the end of the year. So if your cost of capital is, say, 15%, then you still have a margin of 15% to play around. So that's number one. If central bank was to lower their CBR rate to, say, 8% or 7.5% where it had been, then our interest rates will go down. Number two, that government should be able to do is to go easy on their domestic debt borrowing. If that was to happen, then you'll find that commercial banks will be awash liquidity that they want to dispose to the private sector, and you'll see them starting to knock on businesses to be able to lend to them. But as long as the government is borrowing locally, then most of the liquidity will go to them. And then the last and most important is the operating environment. And I can tell you the operating environment for most commercial enterprises is not very easy in our country. And number one, because of our tax regime. Our tax regime has become so tough for most commercial enterprises to be able to comply. Yeah. Meaning, the moment I get into business, my first risk is what we call a tax risk. If that can be managed so that it's easier even to predict the tax that I'm supposed to pay, and so that our tax regime is not so punitive, then you'll find most enterprises going into business and going to commercial banks to be able to invest. When that happens, then you'll find that our economy grows and we are able to create more employment in the economy.
This is a very, very, timely conversation, George. And of course, we haven't even touched on SMEs by the virtue of them just being, the backbone of this economy. But we look at it from the point of credit. They find it hard to access credit.
Correct.
But of course, something needs to be done for that. Definitely. We'll be having this conversation, of course, maybe hopefully next time when we talk about the second half and it gets to lending habits. That is George Munga, a finance and accounts insurance analyst, talking to us about, the first half of 2025, that is January 1st to June 30, how we have been doing and our behavior in regards to lending and borrowing. That's it for this conversation. Thank you so much, George, once again.
Thank you.
Right about now, we want to take a look at arrowroot farming. You're watching Morning Cafe. My name is Anne Odida.